Welcome, traders and investors. It's TradersArmy.com Options Foundations as we continue along the path to gaining more knowledge and skill building in the options trading market. Now we're going to move on to the topic of premium calculation. Before we do that, I want to remind you guys that you can always contact us at support@TradersArmy.com. There's also contact us pages directly on our website, TradersArmy.com, and we encourage you to reach out and get in touch with us if there's any questions you have about any of these lessons, any of these web series, anything that you want to see more of here from the TradersArmy.com. We're happy to help in every way that we can. Now, as a reminder, because we just went through what is an option and defining what an option is, a call option and a put option. Remember, an option offers the buyer the right, not the obligation, to either buy or sell the underlying at a specific price, that's our strike price, on or before a specific date, also known as the expiration date. The seller or writer of that option would be under obligation to deliver or purchase the underlying if the buyer exercises their rights associated with the contract. And in every case, the buyer will always pay a premium to the seller in every transaction. And if you remember, we just went through what call options and put options were, keeping in mind that let's focus for a second on just being the buyer, because these definitions are going to come in really handy as we get into premium calculation. So as the buyer of a call option, you pay a premium and now you have the right to buy the underlying at a specific price, which means your outlook is bullish. You could either buy the stock outright or buy the right to buy the stock outright by buying a call option. Now, we need the market to go up. The higher the market price goes, the more expensive the call option will get based on that change in the underlying's value. A put option, when purchased, is the right to sell the underlying at a specific price. So you could either sell the stock outright or you could purchase the right to sell the stock at a specific price. Either way, if you were going to look to sell the underlying or buy the put option, your outlook is that the stock is going down, you are bearish, and the further down the stock goes, which is known as the underlying, the more valuable your right to sell at previously higher price becomes. Okay, so when looking at premium calculation, there's actually a whole derivatives pricing model. I've gotten people in the past who have asked me, hey, who gives the price of an option, right? Where does the price of an option come from? And there are two prices of an option. There are the theoretical value of the option, and then there's the actual trading price of the option. The theoretical value is calculated through what is known as the Black-Scholes formula. It was a Nobel Prize winning formula created by Fisher Black and Myron Scholes back in the 1970s, that actually was adopted into the options trading market in early 1970s, 1973, I believe. And this calculation actually runs through several different levels of calculations, building out what is known as the theoretical value of an option, based on where the stock price is now relative to the strike price of the option, based on how much time is left until the option expires, current risk-free interest rates, how much volatility has the underlying stock how much volatility has it already experienced, typically over the last 30 days. So the more volatile the stock is, theoretically the options should be more expensive. The less volatile the stock is, then theoretically the option should be less expensive. If there's more time to an option, theoretically there should be more expensive, and it always will be because there is more time. But there's different factors out there that we'll get into in a later web series, focusing on how do we profit from those factors. But this is, a big portion of the Black-Scholes formula here. We're not going to dive right into the Black-Scholes formula. Some have dove into the Black-Scholes formula to understand the math behind it. That makes you smarter. It doesn't necessarily make you money. So we're going to focus here on how we make money with this information, if you don't mind. So the intrinsic value and extrinsic value relationship, those are the two different components that make up what is known as the options premium: intrinsic value and extrinsic value. Some people will refer to extrinsic value as time value, but we don't necessarily believe that that's the most appropriate term, because there's more than just time in considering this extrinsic value's actual value. So the intrinsic value, let's start there. Intrinsic value, if there is any, is the amount by which the option is called in the money. If this option has real equity or bragging rights, then you have intrinsic value. Let me give you a for instance. A call option. A call option, if it's at the money, let's go with a stock price of 50. Okay, so current stock price is 50. If the stock is at 50 and the strike price that you're looking at is also $50 strike price, then it has zero intrinsic value. Okay, zero intrinsic value. If you were looking at, because everybody can buy the stock for 50, not just you, if you had this call option. If you had the $45 call option, this gives you the right to buy the stock at 45, even though the stock is currently at 50. That offers you bragging rights of at least $5. Okay, of exactly $5 in this example. So it would have $5 intrinsic value. This is the dark green box here. The strike prices are on the left-hand side. So if we go up to the $40 strike price, this one is even deeper in the money because it has more, what? Intrinsic value. So if you had the right to buy the stock at $40 per share, even though the stock is trading for 50, you have $10 worth of bragging rights. Let's go out of the money a little bit and let's go to the 55s. If you owned the right to buy the stock at 55 and everybody could buy the stock for less than you at $50 right now, you have zero intrinsic value, no bragging rights. Anywhere above $50 a share in strike prices and you don't have any intrinsic value. Anywhere below $50 per share strike price and you have intrinsic value. Now, this light green box is what's known as our extrinsic value. Extrinsic value is the portion of an option's premium that is affected by fluctuations in supply and demand for the options. That's known as implied volatility. So if there is great demand for those options, a lot of willing buyers and not a lot of willing sellers, those premiums are going to go higher in price due to that fluctuation in expected volatility. Because that's really the only reason why there would be greater demand today than there was in the past for an option, is because the people who are demanding these options believe that in the future there will be greater volatility than there was in the past. Therefore, implying that volatility will become volatility will get bigger, more violent in the future. Okay. Now, interest rates, risk-free interest rates, as they adjust in value, as they adjust in price, well, then that's going to affect the extrinsic value of the option. But interest rates don't generally change at a very fast rate for us to really be concerned about the changing of interest rates. Dividend payouts, if there's a dividend paid out, that's going to be affected. That's going to affect the extrinsic value and also the passage of time. The passage of time, as each day goes by, the time value or extrinsic value portion of this option will become worth less and less and less. And we'll discuss these factors again in a later web series. Now, if we go to a put option, let's actually stick to the call option for a second. So if we stay on the side of the call option, notice that the highest extrinsic value is right what is known as at the money. So stocks at 50, strike price is 50, at the money. 45 in the money, call option, is going to have more intrinsic value, but a little less extrinsic value because we're paying up front for a lot of intrinsic value. The $40 strike price is even deeper in the money. Therefore, as we pay a more expensive premium for this, at least $10, we're going to get a little bit of a break on the extrinsic value because we're paying up front for all of this intrinsic value. And notice as we go out of the money to the 55 calls, 60 calls, 65 calls, the extrinsic value gets smaller simply due to the fact that the probability of these options ever being in the money and having some actual equity value is less and less probable the further away the strike price is from the current price of the stock. Okay, so extrinsic value is the highest at the money. Extrinsic value is the lowest further out of the money and further in the money. That'll come in handy, as I'll remind you a little bit later, for a different web series on the Greeks, on the option Greeks. Now, for put options, remember, we believe the stock will go down. We want to buy a put option because it offers us the right to sell the stock. If we have the right to sell the stock for 50 and everybody else can sell the stock for 50, again, we have no real intrinsic value. If we purchase the 45s or 40s or 35s and we can say, hey, we can sell the stock for 45 or 40 or 35, says our option, but we don't have bragging rights if everybody else can sell the stock for 50. That's more than what we'd be able to sell the stock for. So anything that is below 45 in strike, below $50 in strike prices would be considered out of the money. In this scenario where the stock is at 50, $50 strike price is at the money, and the 55 strike price in this particular case would be an in the money option, and here's why. And here's why it has intrinsic value. If you stand up and you tell your friends, I own the right to sell this stock for $55 per share, even though the whole market is trading for $50 per share on this. So you have exactly $5 worth of bragging rights, and because we're paying at least $5 for that option, if you wanted to buy it right now, you're paying for all that intrinsic value up front. The extrinsic value goes down in value. Still, notice that the premium, the total premium, is more expensive on an in-the-money option than it ever would be at an out-of-the-money or a at-the-money option. Because when you add the dark green plus the light green, that is the total dollars in premium that you would pay. Right now, we're just focusing on how much of an options premium is related to intrinsic versus extrinsic. $60 strike price, the put options say, hey, I can sell the stock for 60. Everybody else can sell it for 50. Therefore, you have $10 worth of bragging rights, and you'll pay for that up front if you want to buy that, which means you're going to catch a little bit of a break on your extrinsic value. Looking at a short-term option chain here, what you'll notice is that this particular underlying is priced at 155.04. Look at where my cursor is, 155.04. So if you look at the strike prices on this series of options that, by the way, expire in 8 days. That's what this option chain is telling us, that these will expire on October 13th, 2017. There's 8 days until expiration, and these are a weekly series of options, and each option contract represents 100 shares of the underlying. If you look right down the center, you'll see varying strike prices. Okay, here's how you're reading this option chain. All the strike prices are down the center, typically speaking. All your call options are going to be listed on the left. All of your put options are listed on the right. And you can select in your option trading platform how many different strike prices or series of expiration weeks and months you really want to see. So right now we just brought up 1 month, okay, or one series of options, which are weekly options. Now, if the stock is at 155 and you look straight down, you'll see a 155 call option and a 155 put option. And if you look at the bid price and the ask price, we know that this is where the willing buyers and sellers are saying they're willing to buy and where they're willing to sell. You have a bid and an ask for both calls and puts. What you'll notice is that they're both right around the exact same price. One would be trading for 163. One is trading for 153. Part of that has to do with one of these is 4 cents in the money. Now I'll give you a minute to think about it. Which one of these options? Is it the 155 call option? Is it in the money by 4 pennies? Or is the 155 put option in the money by 4 pennies? Okay, if you haven't guessed already, and for the sake of timing, it's the call options that have 4 pennies worth of intrinsic value. How can we say that? Well, if you think about what this option gives us the right to do, it gives us the option to buy the stock for $155 a share. Well, if everybody has the market priced at 155.04, we actually have, look at this column here, 4 cents worth of intrinsic value. Okay, so I've actually loaded up the intrinsic and extrinsic value in these columns so you can see that as you go deeper in the money on the call options, these are highlighted in yellow here, deeper in the money call options have more intrinsic value, that's your real equity, and they have lowering or less extrinsic value. Okay, as you go out of the money further higher on this option chain, you'll see no intrinsic value, but you will see extrinsic value also lowering simply because the probability of the, for instance, $170 call options being in the money within the next days, it's so unlikely those options aren't really worth anything at all. Okay. Now, when you add those two premium amounts up, intrinsic plus extrinsic, you will get to the actual premium value that you will pay or receive for those options. Same with the put options. So as we look at this option chain, again, the right to sell at a higher price, follow my cursor, the right to sell at the higher price is going to offer us more intrinsic value and less extrinsic value. The right to sell near the current price, 155, offers us no intrinsic value, but a little bit of extrinsic value for the 8 days that remain. The lower the strike price, these are out of the money options, the lower the strike price for puts, no intrinsic value, and also you'll see extrinsic value depreciating as well, as these 145 put options for the right to sell the stock at 145 are less likely to actually be worth anything given only 8 days of time for the market to get down to 145. So therefore those options aren't really worth all that much. The one thing I want you to notice about when I go to short-term options and I go to medium-term options, something that has a little bit more than 3 months worth of time to it now, 106 days as a matter of fact. These expire in January 2018. Notice what happened to the intrinsic value. Nothing happens to the intrinsic value. However, the extrinsic value does what? It gets a lot bigger. Let me go back. Short-term options, $1.57 for the 155 call options, $1.52 for the 155 put options, because they expire in 8 days. Go to the medium-term options with more than 100 days, and now that instantly jumps to $7.79 extrinsic value for the calls and $7.67 for the put options. Why is there more value here? Why are these options more expensive? Simply for two reasons. Number one, definitely time. There's more time until they expire, and there could just simply be more demand for these options as well because there's more time. And that excess demand is going to add to the extrinsic value premium. Again, you'll see that in the web series on the option Greeks coming up. Now, if we go even longer term, we'll go out to a 351-day option. What you notice is that the intrinsic value, again, the stock price has changed a little bit. There's only 1 penny of intrinsic value here. But the extrinsic value, because there is now even more time, is going to be worth more money. So if you want to buy more time, you'll have to come out of pocket for that more time, and you're paying for extrinsic value, not intrinsic value. Okay? And again, the further in the money the option is or out of the money the option is, looking at the calls here, the extrinsic value goes down. Whether you're talking call options, whether you're talking put options, it's always going to be at the money options have the highest amount of extrinsic value. And the further out of the money and in the money you go, the extrinsic value decreases. Okay, so that's going to become important as we get into later web series. This is just one, just focusing on premium calculation, intrinsic and extrinsic value. If you have any questions about this, feel free to shoot us an email at support@tradersarmy.com. Thanks for watching. See you in the next web series.